Welcome to the deep dive. Behind every big economic headline, every market swing, well, it really comes down to individual companies, right? And their earnings reports. That's where you see it play out. It's like getting a direct look at the pulse of a business. So today we're peeling back the layers on one of those reports. We're doing a deep dive into First Horizon Corporation's second quarter 2025 results. This isn't just crunching numbers, it's really a critical look at how a major regional bank is, handling the current economic climate. We've waded through quite a stack of their documents, the full earnings call transcript, the detailed Q2 earnings report, the slides, everything. Our mission really is to pull out the most important stuff for you, give you a shortcut to understanding what's going on without needing to read, well, hundreds of pages. Okay, so let's start with the big picture. What was the general feeling from First Horizon about Q2? Were they happy with things? And what were the key numbers that jumped out?
Yeah, they definitely seemed pleased. They came across with clear satisfaction about Q2. What
Hmm.
really stood out was their focus on strong balance sheet growth, good credit quality, and a real uptick in profitability. If you dig into the specifics, their adjusted EPS, that's earnings per share, hit $0.45. That's up 3 cents from Q1.
Okay, solid increase.
Right. And their adjusted return on tangible common equity ROTCE, which is a key efficiency measure that jumped 57 basis points to 13.6%.
Mm.
And just for clarity, a basis point is 1/100%.
Mm.
Also, their pre-provision net revenue, PPNR, which sort of shows their core earnings power before setting aside money for loan losses, that grew too, up $4 million from Q1 to $338 million.
Yeah,
So yeah, the numbers point to operational strength.
those are definitely solid numbers, the ROTCE especially. But was it strong across the board, or were there maybe some softer spots? What about the bigger picture? How did they describe the economy they're working in? Any insights there for you?
They called the economy relatively stable, and they mentioned improving customer confidence, which sounds pretty good.
Yeah.
But they were also upfront that, uncertainty remains around tariffs, interest rates, and the economic outlook. Standard caveats, maybe, but important.
Sure, makes sense.
Despite that uncertainty, though, they think the fundamentals in their main southern footprint will stay good for the rest of 2025 and into 2026.
Mm.
Their focus, they kept saying, is safety and soundness, profitability, and sustainable growth. So kind of a cautious optimism, I'd say.
Okay, let's get into the engine room then, how First Horizon actually makes its money. This is usually where you find some really telling details. Net interest income, NII, went up. What drove that? And what happened with their net interest margin, the NI?
Right, so NII was up $10 million from Q1. That was mostly driven by pretty impressive growth in their loan portfolio.
Okay.
However, their net interest margin, the NERE, that crucial difference between loan earnings and deposit costs, it actually compressed slightly,
Yeah.
dropped 2 basis points to 3.40%.
Oh, okay, so costs went up.
Exactly. That compression was mostly because interest-bearing deposit costs rose by 4 basis points. It looked like they paid a bit more on client deposits, and interestingly, brokered deposits grew quite a bit to help fund that loan growth.
Brokered deposits, those are usually a bit pricier, right? Tells you something about the funding environment.
It really does. It highlights just how competitive it is out there for deposits right now. Banks sometimes use those brokered CDs, to bring in cash quickly. On the flip side, their loan yields actually went up by 3 basis points. So they're getting more on loans, but paying more for some of the funding.
That whole deposit pressure and competition thing really seems key. The CFO had this great line calling the deposit repricing cycle more of a zigzag than a typical hockey stick. That sounds messy, less predictable.
Messy's a good word.
Yeah.
Yeah, zigzag perfectly captures it. It's not a smooth upward curve like you might expect. They're constantly battling for deposits. They mentioned competing with offers guaranteeing rates for 9 months just under current Fed funds.
Hmm.
But they did manage to keep about 95% of, I think it was $23 billion, in balances that had repricing events.
Mm.
And they even lowered costs on some of those. So they're navigating it.
Okay, so managing it, but it's definitely a factor.
For sure. They expect deposit costs will probably see a slow migration up over time. Things like the Fed shrinking its balance sheet,
Yeah.
how easy it is now to move money digitally. It all plays a role. It's definitely not a simple spreadsheet forecast.
We've hit interest income. What about the other side? Fee income, was that a bright spot for them, or did they see some challenges there too?
Adjusted fee income, if you exclude deferred comp, was actually down slightly by $3 million.
Okay.
The fixed income business took a hit, down $7 million. Their average daily revenue, ADR, dropped 6% to about $550K. They put that down to a less favorable environment, and the flat short to middle part of the rate curve, basically less opportunity from rate movements.
Volatile too, I bet.
Very. They gave an example from July ADR over 7 in October one week, then down near 450K the next. Just shows you. But there were some positives. Mortgage banking saw a $1 million pickup, likely seasonality. And service charges and fees were up $3 million because clients were just doing more transactions. So kind of a mixed bag on fees, leaning slightly down overall.
All right, let's get into the nitty-gritty of the balance sheet itself. They grew both loans and deposits, which sounds good. Where did that growth actually come from? What's a strategy story there for you?
Yeah, notable growth. Period end loans were up 2%, which is about $1 billion, hitting $63.3 billion total. The biggest piece of that, a $689 million jump in what they call loans to mortgage companies, or LMC.
Ah, the mortgage warehouse lending.
Exactly. That reflects, seasonal trends partly, but also them gaining market share. And it's not just growth for growth's sake. They pointed out this is one of their highest yielding portfolios.
Okay, so that connects back to the margin pressure we talked about. They're leaning into higher yielding assets.
Precisely. It's a smart strategic move, trying to offset that NIM pressure that, frankly, a lot of regional banks are dealing with. They also grew their commercial and industrial C&I portfolio by about $316 million.
Now, you mentioned LMC driving growth, but I saw commercial real estate, CRE, balances actually went down. With all the headlines about CRE, is that a worry, or is there something else going on?
That's a really important question. But no, it's actually seen as a pretty good story for them, not a concern.
Really? How so?
Well, that $223 million decline in CRE was expected. It came from stabilized projects paying off. And get this, it included a $125 million reduction in non-performing CRE loans, plus another $125 million in upgrades out of classified assets.
Ah, so they're actively cleaning it up and reducing risk there.
Exactly. It shows really disciplined underwriting and a proactive approach to asset quality in CRE. That's a key positive sign, especially right now.
Got it. And deposits, did they keep pace? How did they fund that loan growth?
Yep. Deposits grew too. Period end was up $1.4 billion to $65.6 billion. A big chunk of that, $1.6 billion, was an increase in those brokered CDs we mentioned. That pretty much directly supported the growth in the LMC portfolio.
Okay, so using brokered funding strategically.
Seems like it.
Yeah.
They also saw non-interest-bearing deposits grow by about $57 million, helped by some seasonal marketing pushes. So it shows they're agile in finding the funding, even if it means relying a bit more on brokered sources for now.
Growth is good, but like you said, quality matters. What's the word on borrower health, the overall credit picture? Any potential red flags we should be aware of?
They painted a pretty positive picture here. They emphasized borrowers are remarkably resilient. That was the phrase.
Remarkably resilient. Okay.
And the customers are generally in a very positive place. They even expect rising optimism to boost activity later this year as maybe some of the tariff questions get sorted out. Overall, credit trends look consistently strong. Their net charge-off ratio was 22 basis points, right in line with expectations, they said.
So that resilience ties back to the proactive CRE management too. It sounds like they're actively managing risk.
I think that's fair.
Yeah.
They're not just watching, they seem to be managing it. However, they're keeping a close eye on specific areas.
Like what?
On the C&I side, it's mainly consumer-facing type of industries. Think trucking, auto finance, consumer finance, areas sensitive to consumer spending.
Makes sense. And CRE.
Multifamily is the one they mentioned. Not a long-term structural issue, they think, but more of a shorter-term problem. Basically, a lot of new apartment supply coming online at once, slowing down absorption rates. They expect that to sort itself out in a few years.
Okay, so they're being transparent about the spots they're watching closely.
Exactly. Proactive, but also realistic about potential pressures.
Let's switch gears slightly to financial strength, capital. They kept their CET1 ratio steady at 11.0%. For you listening, what does that number really signify about their stability?
Yeah, 11.0% CET1 is right in line with their target range, which is 10.5% to 11%. It's a key measure, Common Equity Tier 1, basically showing their core capital buffer against losses. So 11% means they're very well capitalized, strong cushion to handle shocks, and still support growth. That's important for you to know.
And how are they thinking about using that capital?
Priority number one, they said, is organic loan growth, funding those opportunities we talked about. They did buy back some stock in Q2, about $9 million worth. They still have just over half of their big $1 billion buyback authorization left.
So plenty of flexibility there.
Tons. And they explicitly said they're comfortable repurchasing our common stock if good organic growth isn't there. So that signals a commitment to shareholder returns too.
Interesting point about M&A potentially picking up. They mentioned maybe some positive regulatory shifts. But First Horizon seems really focused on growing organically in their footprint. How do those two things square up? Are they tempted by M&A or sticking to their knitting?
Yeah, it's a bit of a balancing act, isn't it? They did note positive, if not very positive, developments around potential capital rule changes, more tailoring, especially for banks under $100 billion, maybe easier M&A application processing.
Okay.
So they acknowledge M&A might get more active across the industry, but their stated focus right now is definitely organic growth. They feel their 12-state southern footprint has really strong growth potential internally.
So grow from within first, but keep an eye on the landscape.
That seems to be the strategy. Build on what they have, leverage their position in those strong southern markets, but stay aware of what's happening externally. They're not closing the door, but organic growth is the clear priority.
Okay, so let's tie this all together. We've talked about NIM pressure, loan growth, credit quality, capital. What does this all mean for their longer-term goals, particularly profitability? What are they shooting for?
Right, the big picture. Their target is pretty ambitious.
Mm-hmm.
They want to hit and stay above a 15% ROTCE over the next 2 to 3 years.
15% plus, that's a significant goal. How do they get there?
Well, a huge part of it is efficiency and just driving more core profitability. They specifically talked about growing that PPNR, pre-provision net revenue, by $100 million or more in the next few years. And the key lever for that, deepening our client relationships. It's not just about finding totally new customers. It's about getting more loans, more deposits, and especially more treasury management business from the clients they already have.
Ah, cross-selling and deeper relationships.
Exactly. And this ties directly into something else, those big multi-year tech investments they've been making.
Right, you always hear about those investments.
Well, here's the payoff news. Their new general ledger system is now live, operational. And they said they're starting to actually see the revenue benefits from these tech upgrades finally flowing through. That's a really big deal for hitting those long-term targets like 15% plus ROTCE.
Okay, so wrapping up then. It sounds like First Horizon put up strong Q2 results. Good loan and deposit growth, especially leaning into that higher-yielding mortgage warehouse lending. They're clearly dealing with a tough, competitive environment, economic uncertainty, but seem to be managing it with discipline around costs, solid credit culture, and this clear plan for future profit driven by existing clients and their tech finally coming online.
That sums it up well.
What this deep dive really highlights, I think, is the constant balancing act. First Horizon is juggling seasonal business flows, fierce competition, economic question marks, all while trying to keep their eye firmly on that long-term profitability and delivering for shareholders. It's a real tightrope walk. And it makes you think, doesn't it, for any business, really, how much can that kind of strategic focus, that relentless execution, truly push back against all the external pressures? And what does that mean for your own strategic thinking wherever you operate? Maybe think about how this close look at one bank's quarter shifts your view on the financial sector, or even just corporate strategy in general. What's the one thing that really stands out to you from this deep dive?